Hello, welcome to this video. We're going to be talking about money management, but first of all I'd like to take the opportunity to thank you for purchasing the money management spreadsheet that I tailored for not just my trading style but also for your trading style to use in. This is what I use every day for my trading, and I'm sure it's a very useful tool for you to implement into your trading as well. But before I carry on with the video, I just want to go through this disclaimer, and this carries on for the whole of my website. It's a United States government required disclaimer. Commodity Futures Trading Commission and Forex trading, as well as any future markets, has large potential rewards but also large potential risks. You must be aware of the risks and willing to accept them in order to invest in the Forex or futures markets. Don't trade with any money you can't afford to lose. No representation is being made that any account will or is likely to achieve profits or losses similar to those discussed on this website and/or ebook. The past performance of any trading system or methodology is not necessarily indicative of future results. Basically, what we're explaining here is that any money that you put up, it is liable to risk, and just because a certain individual can make money from the Forex market doesn't mean that you're necessarily going to make money either. Don't trade with the money that you can't afford to lose, and any information on this website and/or ebook is purely for educational purposes only. Okay, with the disclaimer out the way, I'm hoping you accept the risks that Forex trading is actually a risky market and is very unpredictable and volatile. So let's just jump back to the website for a little bit. Let's go through a few things we're going to be talking about. Going to be talking about broker leverage. What that is, that's the one that you see on the websites of your brokers as soon as you land on them. Equity leverage, which is something that's not really discussed too much about, and your win-loss ratios, system win rate, a little bit of compounding, what you should be risking on each trade, and minimizing risk. We'll also jump over to the spreadsheet that you just purchased off us. We'll be going through this in detail and how you actually fill it out and how you use this on a day-to-day basis. So back to the website. So one of the great things that I find with the trading Forex is that the trades are leveraged. Basically this means you can put up a portion of a trade and the broker puts up the rest. So you're actually trading with a larger amount of money. Some brokers offer 400 to 1 times leverage, which is definitely not recommended. The broker never really wins or loses any stakes that you put up in a trade. You bear the profits or losses. They make their money on the commissions when you actually place a trade via the spread. When you open the order window, there's a difference in price. They actually take their commissions from that. It's usually around 2 to 5 pips. Okay, but what the broker offers is anywhere from 50 to 1. I've even seen 1,000 to 1 leverage, which is absolutely absurd. So when you're opening up your brokerage account, I recommend that you go for 100 to 1 leverage. This will give you enough flexibility to open enough trades if certain opportunities come along. If we trade with our high equity leverage, usually we can get about 3 or 4 trades on the platform, but then our margin is pretty much maxed out. So go for a 100 to 1 leverage from your broker, not any more than that. Any more is dangerous. And what I talk about here is how actually dangerous it can be. By going for the 400 to 1 leverage, it gives you opportunity. You can even place 15 trades all at one time. Now it's possible for a new trader with the excitement to go ahead and place all those 15 trades, but what happens when they're all against the US dollar and the US dollar starts tanking it in the opposite direction? They'll have 15 losses on the hand, which will probably decimate their account completely over the next hour. So a little description about the outcome of these two accounts. The account number 1, which was placed at 100 to 1 leverage and placed a maximum of 5 trades. If the market went against them, it would be down $200. And if you went for the 15 trades based on the 400 to 1 leverage, the same account would be down $600. Now that was starting with a $1,000 account, and they lost 60% of their account if you trade with the 15 trades. So, you know, not to have too much leverage is a good thing. So I always recommend 100 to 1. Don't get sucked in by the hype of the people offering 400 to 1. It's a dangerous sport, especially in this volatile markets. So the broker leverage is very self-explanatory. Okay. Equity leverage is comparing your account balance to the position size. It requires a little bit more explanation, and it requires your account balance, risk per trade, pips at risk to get your contract size. A few things to consider first. We'll use a mini account as an example. Now I always refer back to a $1,000 account, and it just makes things a little bit easier for explanation purposes. In this case, we're going to risk 3% on every trade, and we risk a maximum of 30 pips per trade. Now this may vary for your trading system. If you do a bit of scalping, it might be 10 pips. If you do a little bit of a higher time frame, you might require more than 30 pips. It might be 60 pips, so you would need to change these variables on the spreadsheet. So in this case, with the $1,000, we need to work out the 3% which we're going to be risking on every trade, and with a $1,000 account, 3% equals $30. So we divide the $30 by the amount of pips at risk. So $30 divided by 30 pips, in this case it's 1, which actually equals 1 full mini lot. Just to break it down, 1000 divided by 3%, which is 30, divided by 30 pips equals 1. This is obviously different for a standard account. You can actually change the variables on the spreadsheet to make it fit. I'll talk about that in a second. So changing the variables for an account balance of $5,000, and we're going to risk 2% in this case, and we're going to risk 40 pips per trade. Now work out the 2% of the account balance, and 2% of $5,000 is $100. So we divide the $100 by 40 pips, and that equals 2.5. 2.5 is the same as 2.5 mini lots. Okay, there's a formula there for you to work out, but my spreadsheet has all these formulas built in, but it's important that you know how it works, just in case you ever need to do it while you're kind of on the go, on your mobile or whatever, just to get to know the formulas and how to work out your risk and position size. So you only really hear about broker leverage as it's their selling technique for the broker. Just do not over leverage your account and concentrate on the equity leverage. This is the most important part. Okay, once you have done this a few times, it becomes second nature, and in no time it will be second nature to you, so you don't need to worry so much about it. Money management is one of the key factors to staying alive in the markets. It can keep your account going just enough for you to bring it back. But if you do not have the principles in place, your position sizing will be too large and you will risk too much, and you'll get wiped out in no time. Just like a three-legged stool, there are 3 levels of support to keep the stool steady. If you take one of these supports away, the stool topples over. And the 3 supports are, first of all, your money management, second of all, trading system, and third of all, your trading psychology. We'll talk more about trading psychology in another video later on through the life of the website, but for now we're going to be focusing on money management and a one-point trading systems. So other things to consider is your win-to-loss ratios, if you're not familiar with this. As you can see from the picture I included, you might need to click on it to enlarge it. How you manage your average profit trades and average losing trades can change the outcome of your trading. If you win the same as you lose, your profit ratio is 1 to 1. There's no point in risking the same as you lose unless you trade with a scalping system and generates 85% wins. If you fall below a 1 to 1 ratio, you're losing more than you gain. So in other words, you'll be gaining 20 pips for every 40 that you risk. And you should look at your system and either stop risking so much or increase your profit targets. The benchmark for trading is to gain at least 1.5 times what you risk, so 1.5 to 1, and the higher the number better. And a good rule of thumb is to go for a 2 to 1 risk to reward ratio. So for every 1% that you risk on a trade, you look to gain 2%. Okay, and the goal is to decrease risk and increase your profits to the maximum potential. These numbers will tell you the health of your trading style, and it's important that you do your analysis on your monthly trading analysis and check your consistency of your trading systems. Report yourself if you deviate from the plan and correct any wrongdoings in the next month. Doing your analysis means that you can identify your problems and correct them in the future. You will be able to identify if your trading system is not fitting market conditions, if you're trading emotionally with fear or greed, or if you're risking too little or too much, and if you have any bad habits. You can weed them out, but you need to identify them first. And your success is down to the analysis of your business. Your system win rate is quite simple, but when it comes down to the monthly analysis, it means everything. This operates in a percentage of wins against losses, and you should divide the winning trades by the total trades, give you a percentage of the win rate. This figure works in tandem with the win-loss ratio when it comes to your analysis and the balance at the end of the month. If you change the variables, the outcome could be quite significant. There is no correct formula, but the formula that works for you has to work with the trading system. For example, you can tolerate less of a win rate percentage if your win ratio is more than 3 to 1 or more, or you can take a 1 to 1 profit ratio if your system win rate is 85% plus. You should familiarise yourself with the formulas and understand the outcomes when you change the variables, and understand what happens when you cut your profits short, risk too much, or get stopped out too often when everything else goes to plan. Okay, so we'll go through this in the spreadsheet and we'll see how a few formulas can come out. Now, compounding is the most interesting part about trading. What is compounding? We're basically compounding the interest, which is our profits from the month previous, and putting that into a new position size. So every time you make a profit, you're increasing your position size every single month, and it's the same vice versa. When you lose, you've got to decrease your position size every month you take a loss. This is so you do not over leverage your position size when you're losing, and when you're winning, make sure that you leverage as much as your profits from the previous month to gain the most potential out of the markets. So as soon as the trading period ends, you want to recalibrate In other words, reinvest the winnings in your account according with your money management plans. So you progress from, for example, starting with a position size of 1 lot. If you achieved your percentage profit, the next month position size would be 1.1. The next month after that, 1.2, as an example, and so on and so on. Only if it's in accordance with the capital that you have gained in your account, and it has to be the opposite if your account becomes negative, like we just said. You need to decrease the position size to match your money management criteria. Use the spreadsheets to make the calculations month by month, and if you make your own spreadsheet, you can calculate how much that can add up to in 5 years. Pay attention to it, and it blew my mind when I first seen it. Just looking at the potential, and it's a very powerful force, compounding. So a simple explanation would be this: you are trading $3,000 with 3 mini lots. You just made $1,000 this month. Would you keep trading with 3 mini lots? No. You would look to compound the interest and increase your position size to 4 mini lots the next month. These numbers are dependent on your money management and should be calculated with discretion. The same applies when you lose money. Decrease your position size. By compounding your interest every month consistently, you can dramatically snowball your account. Couple little demos here, starting off with the $1,000 like we do. This one on the left is going for a 10% profit every month, consistently. Now they're fictitious figures, so they're just made up, and they do round up to exactly 10%. So by starting in, let's just say January, with $1,000, by the end of December, taking 10% per month and compounding your interest, the account could be at $3,137 at the end of the year. Sounds great, you've just tripled your account. But I always aim for a 20% profit target, which in my trading that's 200 pips, which is perfectly achievable. 50 pips per week, which is 10 pips per day. Okay, so the one on the right, the graph on the right, same again, starting off at $1,000, but this time we're going for the 20% profit targets. Same again, fictitious figures, and they are all exactly 20%. Starting in January again, $1,000, gaining that 20%, the account actually ends up at $8,918. Now that's what I'm talking about, snowballing the account. You can imagine what the account's going to be 1 year after that if you're consistent. So being consistent in your trading is very, very, very important, and you should be able to see outcomes like this if you are consistent. Okay, so what should we risk on every trade that we take? You should not risk any more than 2 to 3% of your account balance, 3 being the absolute maximum. You should set the figure for the month at the beginning of the month and stick to it. Okay, so if you have a $1,000 account, you multiply your dollar figure, round it down, make it easy, so it's round it up or round it down to the nearest 100 or 1,000. So we're going to do $1,000 times that by 0.03, which is 30%, and as we talked about, that's $30 already. So $30 is the maximum you're going to lose in any single trade. To get the position size, we already talked about that. You divide your dollars at risk by the pips at risk, and it gives you your lot size. So why 2 to 3%? I know you want to make money fast in the market, right? Because that's what everybody claims that happens. But having a long living account balance is a must. Even if you have 10 million in your account, if you risk too much as a percentage, you will burn out in no time. The reason I recommend 2% as a new trader is so that you can keep the account alive for as long as we possibly can. So that we'll use a $1,000 account as an example again. So if you risk 2%, which is $20 on each trade, you can lose 20 times in a row and lose 40% of your account. If you risk 3% on a trade, which is $30, you can lose 20 trades in a row, and that will be 60% of your account. Now if you risk 5% on a trade, $50, you'll lose same 20 trades, but all your account is gone. Okay? So, losing 20 trades when you're a new trader, this can happen very easily. If you don't know what you're doing, you can get wiped out. Bang, your account's gone if you risk too much. Okay? And the idea of keeping your account alive long enough is so you can learn all your mistakes, change your mistakes, and keep going, keep alive for another trading day. And every day is a process, a learning process, and it's all striving to accomplish a goal. Okay, so losing 20 trades in a low is very likely as a new trader. So you can see just a simple 1% change in your risk can dramatically change the outcome of your losses. You can recover from a 40% drawdown, even a 50% drawdown, but it's a little bit harder to accomplish a pullback from a 60%. But it's definitely not recoverable to pull back an account which has been annihilated to ground zero. You want to look towards a long, well-managed trading career. Do not take big risks and learn through time. Risk no more than 2% to begin with. Make it 1% for your very first trades, and increase the position sizes as your ability increases, but still to a maximum of 3%. Okay. Next section is minimizing risk, which is a must as a trader. Do not take excessive stop loss orders without decreasing your position size, which is your leverage first of all. We talk about minimizing risk methods on other lessons for you to implement into your trading strategies, but what I want to talk about here is what it can do for your win-loss ratios and the average win versus the average loss. If you trade with a 30 pip stop loss and a 30 pip profit target, that's a 2 to 1 profit to risk ratio, which is a good trading strategy and is usually expected. It's a good rule of thumb. But if we could reduce the risk by waiting for a 5 pip pullback and risk only 25 pips with the same profit level, which will now be 65 pips profit, because it's still got the same profit target, but we waited for a 5 pip retracement, so you're only risking 25 pips now, but a profit of 65. That has now changed the variables from a 2 to 1 to a 2.6 to 1 profit ratio. That's the power of minimizing risk, and that's only with 5 pips as an example. And if you can do this all the time, your money management will be solid. The trading system will see better results, and your psychology will definitely be in a happier place when you see your account grow. So make minimizing risk your new hobby. Okay? Wait for those pullbacks. They seem to always happen. Okay? Okay, so that's a little portion of the website. So we'll head over to, you should have this spreadsheet by now. It's a money manager. So how to fill this one out? I'll zoom in a little bit so see a little better. So we're still sticking with the same account balance of $1,000. Leverage amount, I trade with a leverage amount of 10 to 1, which means that for every $1,000 in the account, I'm trading with a $10,000 account, which just happens to be one mini contract. A one contract is $10,000 in the marketplace. Okay, that's a maximum. Okay, like I put it up here, recommended leverage for beginners 2 maximum. Okay, when you start getting a bit comfortable and you become a novice, 5. And for professionals who like to risk a little bit more, 10 to 1. Okay, so risk per trade 3%, as we always talk about, and the account type, so it's set at 10 just now, but we'll do 1 because we're sticking to mini lots. So this is just to help the formulas down here, and just to fit different traders, because some people have mini accounts, some people have standards accounts. So our monthly profit target required as a percentage, I put down as 20%. Now, you only input the data into the green cells, please. If you start changing the other ones, you're going to delete the formulas that are put in behind them. Now, for your trading style and your position sizes, you can change these numbers as you see fit. This might be 10 pips to risk, this might be 20, and this will give you the position sizes for those trades. But we're going to change this back to 30 pips and 60 pips, and I'm just going to delete these guys. But you can put in your figures there, okay? Hi, sorry, I just had to change the formula there, but we'll go back up to the top. So, still with the $1,000, what we're going to do now is we're going to change the leverage amount. We're going to change it to a novice trader, so we're going to do a 5 to 1 leverage amount. So what this does, it halves our risk per trade, it halves our position sizes, because we're not going to full leverage. Okay, we're going to take the risk per trade down to 2%, mini accounts that, and the monthly profit target, because we're trading with half leverage and risking less per trade, we have to decrease our monthly profit target, because as you can see down here, with the position size that we operate with, you would need to gain 600 pips per month. Now that's a bit far out of reach. It's not practical to have that 600 pips as a target. 1 to 200 pips per month is a good guideline to go for. So we need to change these variables. We're going to cut that down to, well, if you halved it to 10, it's going to give you 300 pips, right? It's still a bit out of reach for a beginner trader, so we're going to do 5% per month. Don't forget, you can always change these as you go on, but when you're first starting out, definitely good figures to start with. So for the $1,000 trading at half leverage, you're going to be risking $10 in every trade. Okay, nice round number for you. So you risk 10, look to gain 15 to 20. Position size for that is 0.33 mini lots, and for anything that's above 30 pips up to 60 pips, you trade with a 0.17 lot, still risking $10 per trade. Okay, you can step it up to 100 pips, so you'd be risking placing a 0.1 position size and still only risking $10. Okay, whatever your trading style is, put it in, make it work. Now the dollar profit at the end of the month is $50. Okay, and your daily profit target, if you were trading on a day, is $3 per day. Now that's worked out by 20 trading days on average in a month, Monday to Friday times 4 weeks. It's usually about 20 trading days. So 50 divided by 20 is 3. So the monthly pip target in this case is 150 pips per day. Okay, for the whole month, and that equals 8 pips per day on average. Okay, you might get 20 pips in one day, 20 pips the next day, and then you stop trading for the week. Okay, but on an average, it's 8 pips per day. It should be accomplishable, right? Being 8 pips in profit per day, that'll give you 100 pips per month. which in turn will give you 5% on your account balance. Okay, so now we got to know these numbers. I always like to reset them back to my trading system. They're nice and round for me. It's what I'm used to. So for every $1,000, I'm trading at 10 to 1 leverage, 3% risk per trade on a mini lot, looking for 20% per month. This works out to $200 a month on a $1,000 account. Daily profit target of $10, monthly pips 200, and a daily pip target of 10 pips per day. Okay, down here, pip prices for your currencies. They can be found online from your brokerage, not platform, but their website. You have to display these, and they do change over time. The prices change when the chart price changes, when it goes up and down. So you'll be looking at changing these on a monthly, if not monthly, definitely quarterly periods. Now it is important because there is fluctuations in price. At present, the United States Japanese yen, New Zealand Japanese yen, and the Euro Japanese yen are currently below $1 per pip. Now in some cases and some other pairs, let's say for instance the Euro Great British Pound, at one point that was at $1.4 per pip. Okay, so they do change quite a lot, and that can dramatically change your risk per trade. Okay, so it's important to know these numbers. So get them from the website, put them in here, pay attention to them, and if any start going above the $1 mark, consider not trading it as much, okay, or cut the position size on that currency. Got here a trade logger, so you can put the dates, keep a track of your trades through the month, put your symbols, and that way your currency symbols, Euro, Japanese yen, whatever it is. When you can see if there's a profit and loss, if you can see the Euro Japanese yen you've been losing, consider not trading that for a little while. In this case, we go up to the start balance, enter here into the green cells, $1,000, full position pips to risk. Okay, so whatever I specified or whatever you specify as your trading system as your full maximum pips at risk, I want you to enter it into this cell, please. This will help the formulas down here. We're basing it on full position sizes, okay? And same again for the mini or standard account, enter 1 or 10. Okay, so only the green cells you should enter into. All the other formulas are hidden behind the grey cells. Okay, and it gives you a little insight into how your trading activity is going on through the day or month. So if we're just putting in a few dollar symbols here, we can see the chart on the right changing as we go down. Okay, same as when we go in for losses, put in a few losses. Now it is, the data is collected from the total pips, as we can see here. It will have a zero line, and if we start going into negative, it will drop below the zero line. Oops, don't know what I just done there. Try that one again. It will drop below the zero line, where you can clearly see that you're in negative equity for the month. So you'll need to, once you know you're in negative, then you'll need to brush up your skills a little bit for the month. We're not talking about increasing any position sizes, we're just talking about tidying up your trade and make sure you only take the best trades, okay? So it'll keep a track of your account balance, it'll tell you your total pips, how many you've gained, how many you've won, your average pips, so that'll work out, it'll do an average. as long as this stays above a zero figure. So if it's a positive number, then your account balance should be positive. As soon as it starts dropping down into negative, you know that the average pips you're actually losing. Okay, so good little spreadsheet to use month in, month out, week in, week out, whatever you want. And we've got total gains, as we can see here in the right hand column. So it also tells you your next position size if you like to compound your interest on every trade, which I know a lot of new traders actually like to do instead of fixing it at the end of the month. This will actually work out your next position size for the next trade. Okay, so you can see it compounds quite nicely here. Okay, and that will increase or decrease according to your account balance. Okay, so use this every time you place a trade. Put in your dollars gain at the end of it. Some brokers charge you commissions for placing trades and closing trades, as well as the spread. You don't need to worry about the spread because it's incorporated into your profit and loss on the dollars, but some brokers actually do put on an extra commission as well. So put your commission in here. Risk per trade, enter this one manually, so if you want to, just enter 2 in there. Drag that all the way down, that will change all the columns. Okay, so that's a pretty straightforward recording device. So the next one here is for defining our win rate and win ratio, and it keeps a track of it for the full year and a bit. Start off at the beginning of the year or whatever point of the year that you're at, and enter the sales into here. So let's just say we had 20 trades this month. Winning trades were 12 of them and losing trades were 8. We had 0 break-evens. In this case you would have a 60% win rate. Okay, win rate is in this section here, so put in your 60%. that will give us a little figure up here. Let's just say next month you had 25 trades altogether. Okay, 20 of them were winning and 5 were losing, no break even, 80% trade. So punch in 80. Let's just say the month after that it says still had the same 25 trades. Let's just say we had 10 winners and 15 losers, 0 break evens. It's now a 40%. Okay, so this tracks it through the year, and this will check your consistency for the whole year. Once you fill all these up, it should be on a nice steady level. If it's fluctuating quite a bit, maybe you just need to brush up a little bit on how you actually pick your trades. Avoid the dodgy markets. Okay, so once you get a win rate of 40%, stop entering into markets which are choppy and don't look good. It might seem that you're chasing trades, and just take any opportunities. So now we're going to talk about the win ratio. So your average win and your average loss, and this formula is going to work out for you, and this is going to be the 2-to-1, 1-to-1, 3-to-1 ratio. You can afford to have a low win rate as long as you have a very high win ratio. So let's just say your average win was 20 bucks, average loss is 10 bucks. Straightforward, 2-to-1. So we just put 2 in here, okay? Next month, 25 and 7 loss, so 3.6. But then maybe the next month was a bit poorly, so 15, and then the average loss was 17. Now we got a 0.9-to-1. Okay, so it's a good way to track your performance and see which area you need to brush up on. Okay, whether it's the win rate or the win ratio. Okay, when these things change, it's going to change the outcome of your trading account. There's no correct formula to which works, but there is rule of thumbs. If you can get a 65% win rate on your system and a 1.5 to 1 win ratio on your systems, then that's considered pretty good, or it's the benchmark. Okay, so utilize this tool and track your performance. Next one is the longer view. So I think I've got about 3 years worth of data to enter here, and this tracks it on a month by month dollar figure. So start balance, if we were starting at $1,000, that's going to start bringing our formulas up. Start date you enter, account number you enter, and profit requirement we're going to leave that at 10% for the full duration. And let's just say month balance at the end. Let's have a look at the formulas. Let's see what it tells you. So this little section over here, this will tell us that the account balance at the start is $1,000 and your 10% profit target should be $100. So the projected outcome of the trading at 10% is $1,100, which equals $5 a day. So let's just say we did gain that $1,100. Now we've got an entry on our chart over here. Next month, your $1,100, expected profit $110 with an outcome of $1,210. So let's just say we achieved that as well, $1,210. Okay, now you can see the chart, second entry in there. Okay, and I'm just going to keep going on. So 1331, 1464, 1610, 1771. Now as you can see, the account is starting to grow exponentially. Now we've almost doubled it after just a few months. Okay, that's how important consistency is. Even with a little profit target of 10% per month compounded, it's incredible. 1948. Okay, so the month after that, the expected profit would be 2,143. Now you can keep going with this, keep going all the way down. And what I recommend you do, that when you come up with your trading requirements, whether it be 10%, 20%, 15%, 5%, whatever it is, you put all the data in here. Do what I just done. Give yourself an outlook on what your account balance may be at the end of the chart. Now you can always expand this a little bit. You can drag these cells down, re-enter the chart data. If you're familiar with the Excel spreadsheets, you can do that. But yeah, have a look at what the future would be like in 1 year, 2 years, 3 years, and 5 years. These will be our goals, but be conservative on your profit requirement. And for the purpose of working out, just have a couple of a few losses in here as well. So let's just say 8 winning months, and the remaining months would be let's just say a 20% loss. Okay, this could be a reality of your trading, and just see where you'll be at in 3 years time. If you withdraw money from your account, we've got a cell you can put it on here. So you take out $200. This will work it into your the formulas for the projections. Okay, so it's a great tool to have and implement into your trading. And once you do this month in, month out, it's going to become religious for you. But it's going to give you really good insight into how your trading activity is actually, the health of it, and how it's performing, and how far you've come since you've started, or vice versa, you know. But it's implement it into your trading today, and just take the opportunity to thank you once again for purchasing it. I encourage you to go back to the website and just read through everything that we just talk about. I'm sure you don't want to listen to my voice all day, so take it at your own pace. Go through the website, watch the video again to recap on any points, and yeah, just thank you for purchasing this spreadsheet off me. I hope you have success in your Forex career, and if you like the software, feel free to post a comment on Facebook, on the website, and just share your interests. And if there's anything that I need to add to it, feel free, give us a comment, and I'll get in touch. But thanks for watching, and good luck with your Forex trading. It's an exciting venture, and it's a great business. So good luck to you. See you on the next video. Cheers.